So this is Mortgage 101. We're going to go over, this is pretty comprehensive. It goes over a lot of information. So if you have any questions, just, feel free to jump out and ask it. But we're going to be going over the mortgage process, application, underwriting, approval, processing, and closing. That's towards the end. We're also going to go over some of the main loan products like FHA, VA, USDA, conventional, and also some remodel rehab loans that are available as well. And this is an overview. If you have real specific questions, I'll try and answer them now. Otherwise, you can get a hold of me afterwards and we can figure things out, okay? The first one we're going to go over is the FHA, Federal Housing Administration. Now, what a lot of people don't seem to understand is that FHA does not do loans. The banks are the one who give the loans. FHA guarantees the loan to the lender in the event of a default. Basically, they're saying, hey, if somebody defaults, goes into foreclosure, you have to take the house back, Mr. Lender, we're going to make you right through our guarantee and mortgage insurance. And that's kind of the purpose of mortgage insurance anyway. It was created by HUD. Excuse me? Somebody say something?
No.
No? Okay. It was created by HUD to provide low down payment options for people because back in the day, this was back in the 60s where it actually came out, 20% was the norm. And this was designed for people that had a little bit less, that had a lot less down payment available. And so it's 3.5% down. So on a $100,000 loan, easy numbers, it's $3,500. So for every 100,000, about 3,500 is down payment. Credit scores can actually, it says here, it goes down to 600 and it can. There are some overlays, but FHA says that they'll guarantee a loan to a lender at 580 with 3.5% down, and all the way down, I think, to 500 with over 10%, about 10% down. The problem is finding a lender that's willing to take that risk, okay? Because ultimately that's what it boils down to. The lower the score, the higher the risk. Anything under a 640 can be difficult to approve with FHA without compensating factors. And compensating factors are things that would give the lender a warm and fuzzy feeling about giving the loan. In other words, I did one about a year ago that had she was a 589, but she had about 200,000 in 401k money, and which was available to her in the event of emergency. So that was a huge compensating factor to the lender, and they were willing to overlook the collections and everything else that went with a low score. It does allow a higher debt to income ratio than, say, for example, a conventional loan, which maxes out at a little under 50%. Can't go past 50% debt to income on a conventional. We'll go over that in a minute. But on FHA, it can go as high as 55, 56 if we can get an approval. It all depends on that. An automated underwriting approval. Non-occupant co-buyers are allowed. That's basically somebody that can be a co-signer on a loan, but doesn't have to live in the house. And they can also own another home. For example, a co-signer can have another house, but they can be on this loan to help a family member out. It does have to be a family member for FHA. All down and closing costs, et cetera, can be a gift from a family member. And a family member can be anybody that's blood relative, but it's also somebody that you've had a long-term relationship with as well. There's a guideline, and you have to kind of prove that out, that you've known this individual for quite some time. I've had underwriters ask me for pictures. So that's kind of strange, but they've done that. The mortgage insurance on an FHA is set in stone, basically. It's 1.75% is the upfront mortgage insurance, and that's added to the base loan amount. So they have two types on the FHA. There's upfront, which is added to the base, and then there's a monthly, which is 0.85 of the loan amount on a monthly basis, 0.85%. After about 10 years, it reduces a little bit, but the mortgage insurance stays with an FHA loan for the life of the loan. And in order to remove it, one has to refinance out of it. Do you have any questions on the FHA right now?
Nope, I'm good.
So just to make sure, it's clear you don't have to be married to be in a co-borrowing situation.
No, no, you don't have to be married. A co-borrower or a co-signer. Well, it doesn't really matter. I've had on an FHA loan, I've had multiple people on the loan together as borrowers, but as a co-signer, you don't have to be married. Non-occupant co-signer, you don't have to be married, but it has to be a relative. It can't be your girlfriend or your boyfriend or something like that coming in and helping you. They have to actually be on the loan.
Okay.
Yeah, that's pretty much it on that.
Okay.
Okay. The next one we're going to talk about is the VA loan, which is the last one that I did. So this is kind of, for those of you that were on that, this will be a little bit different. Hello, Martha. I just let you jump in here. Yep, there she is. So on the VA loan, this was also created by HUD to provide no down payment assistance, no down payment loans for veterans and in-service military. Similar to FHA, they have some relaxed qualification standards to help the veterans out more easily purchase a home. So it's a little bit easier for a veteran to buy a home. VA has made some adjustments to their guidelines in the last year that really looks closely at collection accounts, etc. Now you can go down again as low as a 580. Most the lenders won't do a VA less than a 600 or a 620. But you can go down to 580 with compensating factors. And again, that's something that's going to alleviate or remove some of the risk in giving a loan to somebody who has a really low FICO.
Pues haga de cuenta que no, que le sale bien porque vende su casa cara y obviamente pues va a comprar caro, pero no le pierde nada porque la ganancia está también en su venta de su casa. Ajá, pero ya pues, sí, obviamente ya cuando bajen pues va a vender.
You're breaking up on.
Si piensa vender más adelante pues se vendería más baja y pues obviamente compraría más bajo. Sí, lo mismo. Ajá. Si va a vender y va a comprar es lo mismo. Obviamente se van a comprar y es posible que se puedan esperar, pues sí.
Hola.
Are you talking to somebody else, Martha, or me, or what? I guess somebody else. She's gone. Okay, so you can go down as low as, I keep messing this up here. Where is it? Okay, there it is. Ideally, we try to help everybody. Groups. Higher debt to income ratios, again, similar to the FHA, it can go up to well over 50%. But again, it has to be there has to be compensating factors, but also on the higher debt to income ratios, we have to take into consideration with VA what's called residual income. So there has to be enough money left over on a monthly basis, depending on how many people are in the household, to pay the rest of the bills. So VA is very cautious about that. They make sure that the veteran can buy a house, but they also make sure the veteran has X amount of dollars available after everything is said and done to pay the rest of the bills, utilities, etc. There's an entire worksheet that we have to complete. Pretty what the residual income is and what it needs to be. So that's another thing on the back end that I do. Closing costs can also come from a gift or paid by the seller, as well as with the FHA loan. Down payment, obviously, there is no down payment if a veteran has full eligibility. VA guarantees up to 25% of the purchase price, which if you've used it already once, you can use it. You can get another VA loan as long as you have some more guarantee left, okay? And we order that certificate from VA, and it tells us how much is left on their guarantee. Unlike FHA, there is no monthly mortgage insurance, but there is a VA guarantee fee. Similar to FHA, where there's an upfront fee that's added to the base loan amount, VA has a guarantee or a funding fee that can range anywhere between 1.4 to 3.6. 3.6 is for subsequent use. Yeah, the higher one is for subsequent use, and then it's a little bit lower for first time use. Veterans can get more than one VA loan. A lot of people don't realize that. I'll do my VA class again one of these days. Any questions on that?
I
Okay.
guess it looks like,
The other one that excuse me?
Tony, so it kind of looks like I mean, it's really good. They take care of the vets. I mean, that's a pretty good deal, but what you're saying is they're much more hands-on. They're scrutinizing your debt to income detail.
Yeah, they do. Yeah, on the residual income, they really scrutinize that and make sure. I mean, it's they don't really scrutinize it per se, but there are guidelines. If you have 5 people in the household, you should have X amount of dollars left over, and the country is divided into sections. So depending on if you're in the West Coast, East Coast, it depends on that as to how much of a residual you need to have. So that's it's something that needs to be monitored, because sometimes you can do a whole full loan approval on it, and then come to find out the underwriter did the calculations and the residual income is off. So we have to be very conscientious of that in the beginning.
Right.
When I do the pre-approval or the pre-qual, I have to watch that real close.
Okay.
Okay.
Yep.
There's also the USDA is another government loan that's available. It's the same people that inspect our meats, etc. They also have a lending division or a guaranteed loan division where they will guarantee loans in rural housing. And rural housing, the area is defined by the population. For example, here in Arizona, Casa Grande used to be all about USDA loans. But then they got so big that USDA adjusted their map, and now they're not within that area. And when I say a map, so USDA has a tool online. You can Google it, USDA housing eligibility, that kind of thing, and it'll put you up to the map. You put in the address that you're thinking about, or an address close to where you want to live, and it'll tell you whether it's eligible or not eligible for a USDA loan. USDA is also a no down payment loan. You don't have to have any money down for that. They do have a guarantee fee, which is similar to mortgage insurance. It's an upfront mortgage insurance premium, 2% plus 0.4 on a monthly basis, and up to a 50% debt to income ratio. This part, household income caps depend on the number of family members. So what USDA does, and this is interesting, they look at the income of everyone living in the house, regardless if they're on the loan or not. Okay. So if somebody has mom living at home and she's collecting Social Security, I have to take that income into consideration for the household income cap. Okay. So it's something that we talk to the borrowers right away to say, hey, who else is living here? When you're doing USDA, we have to include everybody's income, kind of get everybody's head around that, whether they're eligible for that. Specific rural areas are only, so that's very specified, and that's where the map comes in. 640 FICO minimum to jump in on this one. Also, USDA is double underwritten. It's underwritten by the bank, whichever bank that we're doing the loan with, and then it's also sent over to the USDA underwriter. And right now, I think they're in Prescott, or they used to be in Prescott, and then they will underwrite the loan as well to kind of validate whatever the bank has confirmed. Any questions on that? We don't do a ton of these. They are available in places like Arlington, little outskirts area around Buckeye. But it's really, you really have to drill down on that map to make sure that the property you're looking at is eligible for this. If you guys have any questions like that, just feel free to send me the address and I can look it up, and then I'll send you a link to the area lookup, the map lookup.
Yeah.
Any questions?
Yeah. So it used to be that map was pretty full, and now it's evolved into where there's hardly anything left. Right?
Yeah, it depends on the areas. I mean, yeah. It used to be pretty big. I mean, Anthem was on it. We did a lot of USDAs out in Anthem. I mean, it just all depends. So it's you you got to be very careful as to, looking it up and making sure that the house is eligible.
Yeah.
And you do that up front.
Okay.
But yeah, it used to be where you can do them anywhere. I mean, a lot of places, not downtown Phoenix, obviously, but in a lot of places, especially here in Arizona.
Yep.
The next one is conventional loans. Okay. So conventional loans are loans that are non-government insured, although strong government oversight. So in other words, they're not insured by the federal government, like FHA. They don't have any sort of guarantee. You have to go through a third-party private mortgage insurance company for that. Back in 2009, when the market crashed, they were put into a receivership. Basically, they were being monitored by the federal government. They've been steadily coming out of that right now. Loan standards are highly regulated by the federal government. So all of these programs literally have manuals, and nowadays you can look them up online, which is great because I can do a PDF search versus the old days when I had binders. In the old days, I'm talking 10 years ago, 12 years ago, they had binders that I would have to go through to figure out if somebody was eligible for a certain loan program.
Yeah, I would have guessed. I would have figured you'd have said 20 years ago, at least 20 years ago.
It's almost getting there, man. I'm at 17 going on 18. It's almost getting there. But yeah, there was a point where I used to have binders all over the office just to make sure that if I had a question, there was something I could look up. It was crazy. Maximum conforming limits. So every area, every county basically has a maximum conforming limit. Anything over that amount, it goes into what's called a jumbo loan status. So here in Maricopa County, it's 510,400. So that's the loan limit. So the purchase price can be greater than that, but the maximum loan that somebody can get would be 510,400 to keep it at conforming. Once it goes to $1 more than that, then it becomes jumbo and the rules change and you have to go do jumbo guidelines. Okay. In most counties, like I said, it's 510,400, definitely here in Maricopa. Higher priced areas, Hawaii, California, East Coast, they can go as high as 765 on a conventional conforming loan. They are more stringent on qualifications and lower debt to income ratios. Again, 45% is like the sweet spot. I've gotten approvals at close to 50, but that's, high credit scores, a lot of compensating factors. So it's a little bit tougher to qualify for a conventional, but not, these are great loans, honestly, for anybody that's 680 or higher. Ideally, a conventional is ideal at 710, 720 is where you start getting the benefit. The guideline says you have to have a minimum score of 620, but that only gets you a seat at the table. You still have to get an approval. And then also the mortgage insurance is astronomical at lower FICO scores. I'll go over that here in a second. They do have a 3% conventional down payment program. They created that to kind of compete against FHA with the 3.5%. And it's designed for first-time home buyers. So somebody on the loan, let's say you have two people on the loan, one of them must be a first-time home buyer. Does anybody know the definition of a first-time home buyer?
3 years.
3 years, that's right. Cannot have owned real estate within the previous 3 years. If you haven't, let's say you lost your home in 4 years ago or whatever it is, or you sold it 4 years ago, you're considered a first-time home buyer and you would be eligible for this type of program. Okay. Monthly mortgage insurance is private monthly. Okay, I'm trying to read this. So monthly private mortgage insurance by both down payment and credit scores. So it's not like FHA or even VA or USDA that has a set percentage. MI mortgage insurance for a conventional loan is a factor of loan to value, how much money you're putting down, what is your credit score, and what is your debt to income ratio. Those three things determine how high your mortgage insurance is going to be. So obviously, if you have somebody that puts down really low, 5% down payment, their credit score is under 700, debt to income ratio is over 45%. The mortgage insurance is going to be a little higher than somebody else that's better, has a lower amount. Hi, Lindsay. Welcome aboard. So that's the mortgage insurance there. There's about 4 MI companies. Yes, ma'am? Anybody ask? Okay. So there's about 4 or 5 MI companies that we search, Radian, Ascent, Magic. And we actually go, they have engines or tools that we can go online. I call them engines. You can put in the parameters of a loan and it'll spit out what the mortgage insurance premium will be. The other thing with conventional loans on the mortgage insurance is that the package, the loan itself, is also underwritten by the MI company. Okay, so they will go through underwriting, regular underwriting through the bank, and then the MI company reviews the loan to confirm that it falls within their guidelines. Okay, so that's all done on the back end. We don't have to worry about it, but something that I also have to learn, kind of have an understanding of what their guidelines might be. Again, credit scores greatly affect the rate and debt to income and DTI. Okay, any questions on conforming, conventional?
Good.
Mute. Let's see here. Another conventional loan would be a jumbo loan. So that's anything over the 510-400, a little bit more difficult to qualify. Used to be you could do a 5%. There was places that you could get a 5% jumbo, 5% down, I mean. Now they've gone up quite a bit to, 10, 20, depends on the credit scores. They do have higher interest rates, greater down payments required. You can get a fixed rate or an adjustable rate on those. Like I said, it's a whole different ball of wax to do those kind of loans. Any questions? Most of the time we'll be dealing with under the 510-400 range. The other loans that I wanted to touch on were the remodel or renovation loans. FHA has a 203K. Has anybody heard of that? That's an FHA renovation or remodel type loan. You can do but it's maxed out at 35,000. That means that we would order an appraisal on the property. We would give the appraiser all the documentation that we anticipate in the renovation to occur. In other words, what we're going to do to the house. We use FHA requires that you use a 203K consultant, and that's a consultant here in town that goes in with you in the house to determine what's needed to bring the house up to livability and habitability, as well as help you get contractors, etc., to do the work. But that 35,000, so the appraiser goes out there and appraises it as is, and then it gives you after repaired value or an after renovation value. So that's the renovation value is what we use for the down payment amount. So if it starts out at 200,000 and then it's renovated, it's worth 250. You're actually financing 250 because you're putting the amount that you renovated into the loan, and the down payment is based on that higher amount. Any questions? This one right here, you can't do any structural, can't tear down the house and rebuild it, in other words. But you can, well, because it only, the standard allows you to, how do I explain this? You can have a foundation. So let's say there's a house there and there's a foundation on there. You can build from there up, but you cannot pour a new foundation. It can't be used to add additions to the property, etc. The home style loan, which is the next one, is a conventional type loan. Again, that one's maxed up to 510-400. It's a 90% loan to value, 95% on certain cases. That means that's the maximum even after repaired value. So you still have to put 10% down. In a case by case, you can do as little as 5%, but that's underwriter approval. Owner occupied second homes and investment properties can also be used as home style loan. So somebody buys an investment and they want to do some sort of repair or additions on it. You can do that with this property, with this type of loan. Structural and or cosmetic. Oh, also on the FHA, on the 203K, you cannot install a pool with this loan. Okay. And in all honesty, I don't think you can do it with the conventional either, but I have to look that up to make sure. So I don't quite remember that. That's one of those areas right there where I look it up, if that's what it is. Any questions on those? Okay. So we've talked a little bit about FHA, a little bit about VA, a little bit about USDA and conforming or conventional loans, and then also the rehab loans. Now we're going to go into the actual loan roadmap, what happens. This is where from application to closing, application, upfront qualifying and underwriting, initial disclosures, initial conditional approval, and processing, okay? So kind of, I want to read this. The goal of mortgage applications is to provide the loan officer with, okay. So basically, on the initial pre-qualification, it's not a true application until we have 6 pieces of data, which means social security number, date of birth, an address for a property. There's 6 actual differences. So most of the time, unless it's a refinance, I don't have those 6 pieces until you actually have a contract on the property, and then it becomes an actual loan application. Prior to that, it's a pre-qualification. And to do that, we get just the initial basic information, borrower's information, name, address, date of birth, social. We get a 2-year job history, a 2-year residence history, and I pull up a credit report, okay? So that's the initial thing that happens when I do a pre-qual, or pretty much any loan officer will do a pre-qual, and then we will gather some other information. Because as you know, if you guys have looked on your pre-qual form, it says there that the loan officer has reviewed taxes, pay stubs, etc. So that's when I collect their income documentation, their taxes, their W-2s, taxes for the last 2 years, W-2s for the last 2 years, pay stubs for the last 30 days, bank statements, assets to verify they have the funds, that kind of thing. At that point, I discuss different loan options with the client, whether, you know, the pros and cons of FHA, conventional, of the different loan. Usually it's FHA and conventional, unless VA is in there as well. We discuss interest rates with the client, you know, where they're at and what they're looking at. Most people really are to them, the definition of an interest rate is really what my payment is. You know, can I afford it? And that's a discussion that I'm getting an approval, a higher payment amount, obviously a higher loan, isn't wanting to go that high. So that's kind of a discussion that I have with them, and then I share that with you. All loan information is re-verified with the client, and then at that point, the ideal loan is structured for the client, and we issue a pre-qualification. Any questions? The next thing that happens during that pre-qualification process is what's called upfront underwriting. So not only do I review all the documentation that I've received from the client, saying, yeah, okay, yeah, he makes this much money, yeah, he does $20 an hour, etc. But I also run it through what's called an automated underwriting system, or an AUS. This is a computer algorithm that uses key loan parameters, key aspects of the loan to make a risk assessment of the loan and set limits for required documentation. So in other words, when the AUS is run, it tells me right then and there if it's approved, and obviously garbage in, garbage out. So it's very important to put in good, verifiable information into the AUS, okay? Because if you can't verify it, you can't use it. And then the AUS will spit out the guidelines. They'll say, okay, if I employment from the employer, it tells us what to do, what documentation is required. And that simply is what's submitted to the underwriter at that point, or later on. So this is performed up front by the loan officer or the support team. I had an agent the other day asked me if they had gone to a builder, and the builder had asked if I had run DU or AUS on the client, And obviously I did, and they wanted a copy of that. So before they accepted the offer. Now, when that occurs, I can only send the first page of the AUS findings, they call them, because the first page will give you what it is. It's approved, etc. But the rest of it is a lot of personal financial information that I cannot share. You know, it's not good to go out there and share that without a signed letter from the borrower saying that I'm allowed to do that. At that point, I keep that, and then once I get a contract, I look into finalize, I rerun DU, make sure everything is there. I look at all the information. I make sure that the AUS is still valid at that point, okay? I discuss locking in the interest rate with the borrower. So at this point, so right now we've done the pre-approval, okay? Or yeah, the pre-approval. It's not until I actually get a contract on a property and we have an address that the loan is available for locking, okay? And locking in interest rate is basically saying to the investor, the bank, that, hey, I promise to deliver this loan within 30, 60, 45 days, whatever length of lock it is, to you at this interest rate, okay? The other way is floating the interest rate. That means that we aren't locking yet, but we are going to float it to see if it gets any better. But there is risk to that. And that's a risk that I discuss with the client, saying, you know, unless you have somebody that can counsel you really good, a financial planner, somebody that knows the markets, you know, floating is a risk because we don't know what's going to happen in the market tomorrow. And that's a fact. So the markets tomorrow could decide to go all crazy, and all of a sudden interest rates jump up. Okay, so we always have to monitor that on a regular basis. Sometimes I'll have in a day 3 or 4 different rate sheets because the market is so volatile. Right now, it's not that bad. It's pretty stable. It's staying consistent, so we're kind of watching it. But there's a lot of tools that I subscribe to that helps me monitor. It gives me alerts saying, hey, market is going south, market is going north, you know, alert to lock. It tells me what the situation is. And then I have that discussion with the buyers to determine if they're willing to, what they want to do. Do they want to float it? Do they want to lock it? What do they want to do? Typically, somebody will lock a rate because, you know, the payment is what they want it to be. Everything is what they want it to be. So they'll lock it and get that out of the way. Any questions?
Yeah. When you say that they're floating depending on the market, what does that mean exactly?
Interest rates are governed by the bond market and the mortgage securities that are sold on the bond market. It can be affected by stocks and bonds. Okay, and that's what I mean by the market, the stock and bond market. So rates are affected by that. That's where interest rates come from. And then from there, they trickle down to the actual lenders. The higher the interest rate really is a reflection of the bonds trying to get people to invest in them instead of stocks. So the higher the rate, the higher the yield spread or the yield that the investor will earn on that investment with bonds. You understand? It's a little bit complicated.
Yeah.
I can send you guys out some information on that. But basically, in a nutshell, that's what that means. Does that help a little bit, Adrian?
Yeah. Yeah,
Okay.
it makes sense.
I mean, that's why it changes so much. It's because it's not the bank's rates. It's not. It is in a sense, but we don't control what the rate might be. Ultimately, when we get an interest rate sheet, then we look at it and try and figure out what is the lowest rate that we can offer the client without them paying any sort of points. Okay, and that's what's called par. There's no profit, there's no loss, in other words. So in other words, there's no money left over with the interest rate to help pay closing costs, but there's no cost to the interest rate, so the buyer doesn't have to pay a point or a discount point on there. Now, the definition of a discount point is 1% of the loan amount. Okay, so 1% of the loan amount can buy your interest rate down a quarter point, typically. Sometimes it's a little bit more, but it's typically about 1% or 1 point equals a quarter point reduction in rate. Does that make financial sense? Sometimes it does, because once we figure out with the client, this is what your actual cost is. You're going to save 25, 30 bucks a month. It's going to take you 3 years to break even from the cost that you invested to get that rate. You know what I'm saying? If it takes a long time, 5, 10 years to break even, then it's questionable whether it's even a good thing to do.
Right.
Okay. I'm just going everywhere here. This thing keeps flying everywhere on me. There we go. Once we have a contract on a property and it becomes a live application at that point, then I have I have 3 days to send out the initial disclosures. Okay. Within that 3-day period, what I do is I will contact the title company and get their fees on that particular loan for that particular loan amount. And then I will update what's called the loan estimate at that point to reflect as close as possible to the actual fees that will be charged for the loan. The loan estimate is exactly that. It's an estimate because there's oftentimes we have to disclose fees that may not be used or needed on a particular loan, but is a possibility. And because of that possibility, Congress years ago, I think it was back in 2015, something like that, they said that with the loan estimate, you have to disclose any potential fee that could affect the buyer. Okay. And if we don't disclose that fee and they ultimately are required to have that fee in there and it's not disclosed, then the lender has to eat it. So that's not something that happens very often. So we have to disclose everything. And the loan estimate has a tendency sometimes to scare people because it's like, oh my God, it's so high. And then I go through that with them on an individual basis, discussing each of the fees and saying this one will, this one won't. Well, more than likely won't, but this is what it comes down to. The loan estimate estimates all the fees, cash to close to the client. The cash to close includes down payment. It shows the terms of the loan, whether it's a 30-year conventional FHA, VA. It lists the APR and also the finance charges are listed on that. So the loan estimate replaced the old HUD-1 that we had a long time ago. Okay, and the initial disclosures include everything from the actual application, which we call the 1003, the loan estimate, along with a ton of other paperwork that are kind of like disclaimers. You know, we abide by the Equal Credit Opportunity Act. Mortgage fraud is investigated by the FBI. I mean, there's just a ton of documents that we have to disclose to the buyer. Typically, these are sent out electronically via email, and then the buyer can just jump in and sign them electronically. If they need to, I can sit with them page by page and go through each of the disclosures so that they get a better understanding of what they're actually signing. So that's what the initial disclosure happens. Any questions on that? Again, that happens at the point that we actually have an application, an actual contract on a house, on a property. Then that triggers these to go out within 3 days. Once the, I feel like something's missing here. Okay, upfront mortgage loan estimate. So once we receive the buyer, it's down here somewhere, so I'm probably repeating this, but once we receive from the buyer the signed disclosures, and then there's a form in there that says intent to proceed, is basically saying the buyer signs off saying, based on the information you provided thus far, Mr. Lender, I intend to proceed with this loan. At that point is when it becomes eligible to be submitted to underwriting, appraisals can be ordered, and other things can start happening. Underwriter will review the client's income, their assets, their work history, credit history, debt obligation. They use the application, the 1003, as a roadmap. So whatever we put on the 1003 is what they're trying to validate. They validate the income. They do a whole income calculation on that. They look at the bank statements, the assets. They determine what monies can be used to buy a house. And I'm going to throw this in here real quick on the assets. So the assets really, I got 2 bank statements the other day from a client, and she had put in there almost $4,000 deposit. And it's considered a large deposit, and we have to document and source where that came from. So it's very important for in the initial review, like I'm doing with her, to determine where the money is coming from. The whole purpose behind that, it stems from, oh my God, the Patriot Act. It stems from the Patriot Act that we're trying to avoid any sort of money laundering, okay? Because homes and mortgages can be used to launder money. So they're trying to avoid that. Also, they want to show that the seller didn't in some way help you with the down payment. Okay, so we have to look at that. There are certain guidelines. FHA says, for example, that we don't have to worry about large deposits if the deposit is less than 1% of the purchase price. But again, that's an underwriter call. They can still say, hey, I know it's less than 1%, but I still like to know where that 4,000 or 3,000 or whatever amount of money came from. If it just doesn't make sense, I mean, somebody makes, you know, $2,000 a month in income from their work, and then all of a sudden they have a $4,000 deposit. Usually it's a gift. So, oh, my Uncle Joe gave me $4,000. Well, now I've got to do a gift letter and some other things to validate those funds. We also look at the work history. Work history is huge. Got to have a 2-year job history. Doesn't necessarily have to be in the same line of work, but it has to show stability, that you're not, you know, bouncing around different jobs. FHA, for example, has a rule that you can't have more than 3 jobs in the previous 12 months. Otherwise, you have to be on your job. The current job, I think it's 6 months you have to be on your current job. They look at the credit history, not only the FICO scores, but how you handle your debt, your bills, that kind of thing. They look at your debt obligations, because that's part of your debt to income ratio. So all of this, these are the things that I reviewed in the initial pre-qualification, but I also is reviewed and validated by the underwriter later on. So it's really important for me to be as, the word that I want to use says perfect, but that's hard. So be as perfect as possible on these transactions. Any question on that? Okay. The underwriter usually happens in multiple stages. Initially, we did the AUS, which was the automated underwriting system decision, and that during the pre-approval, this approval comes back to the underwriter. The underwriter also reruns it, validates all the information that I gave them, and then they also do the same thing again, and rerun and validate my findings or my automated underwriting that I received. Here's the part that I was saying seems to be out of order on this PowerPoint. The intent to proceed is what I'm looking for from the buyer to make sure that they want to move forward with this transaction. Initial approval, underwriter reviews the application, determines an initial credit decision, underwriter issues an approval condition list. This is called a conditional approval. Basically, it's a list of items that must be fulfilled in order for us to get a clear to close, okay? It can be validating the assets, for example, that I just spoke of, the deposits. It could be a verification of employment. It could be a number of things. The better the file is when it's submitted, the smaller the list can be. But then there's also a lot of back-end things that need to be done. The processors start working on verification of employments, verification of rents, any of those things, and they're going to be talking about that here in the next slide. A condition list is reviewed by me, the LO, and the processor. We look at that and the processor says, okay, this is my part, this is your part, and then I go after what I can, and then the processor goes after the rest. At that, a home appraisal is ordered if it hasn't been ordered already. Typically, how do I put this? So if there's anything in the file or the loan that makes me think that I want to see an underwriter conditional approval before the appraisal is ordered, then I will hold off on the appraisal. But typically it's ordered right up front at the very beginning of the process. That way it can be hopefully here when the underwriter actually reviews the loan. The processor's goal during the loan process is to help the client and me, the loan officer, to collect documents required to finalize the loan approval. This is the things that, like the verifications that I was talking about. That's another slide here. The processor will also coordinate with the title company, settlement agents, order the title reports, order all those things and get all those things up front. One of the key factors that I try to instill in the clients is that getting the information that we request as soon as possible is what's going to make the transaction go smoothly and quickly. If someone takes 3 or 4 days to get something that we need, it's going to put a damper on the loan process itself. So it's really important to when you talk to your clients that you say, hey, you know, they're going to start asking you for a lot of stuff. Make sure you get it over to them as soon as you can. I try to make it a 24-hour period that a client can give it to me. That way it puts a little urgency under it. That's usually the thing that takes the longest. People just don't seem to have the urgency sometimes to get us everything that we need when we ask for it. The processor, again, home appraisal is received, reviewed by an underwriter. So once a home appraisal is received, the underwriter will look it over, make sure it's compliant. They look for a lot of things. Sometimes they request the appraiser to adjust certain things, never value, but there might be descriptions, different things that need to be adjusted to maintain compliance. But they don't really deal with the value at all. If the appraiser says that certain things have to be repaired or done, then the appraisal comes in as subject to. And those things need to be done because the appraiser has to go back out there to the property and inspect that those things have been completed. And then if there's pictures, they will take pictures and provide those to the underwriter as well. Once the appraiser says something must be done, it usually cannot be omitted, okay? Sometimes it can, it all depends. Sometimes an appraisal will ask for things that we don't need. For example, sometimes they'll say, you need appliances in this house, and you don't really need appliances. Back in the old days, I remember we did need a stove and that kind of thing. VA does require some sort of a cooking surface, so you can have a electric plate, and that would be considered sufficient. It's kind of bizarre. Processor orders verification of employments, and this is to validate the dates that the client gave us that they worked, as well as to confirm income. They might order verification of rents from their landlord to verify that they haven't had any lates on their rents. Verification of mortgage to verify they haven't any lates on their mortgage. For example, if they have a mortgage that's privately paid and it's not reporting on the credit report, then they would order that verification from whomever. Sometimes the title company is handling the transaction. We order the title report. Homeowners insurance is validated. If it's a condominium, we order all the condo certifications and things that are necessary to approve a condo project. Processor collects any outstanding items from the client as well. So if once I get whatever I can from the client, the processor takes it over and starts working on those items that are missing. Can you guys see me? Because I'm starting to use my hands to talk here. It's like being in front of you. Loan is submitted to underwriting for final. So once all those conditions are gathered up, all the conditions for the conditional approval are gathered up, including the appraisal, then the file is resubmitted to the underwriter for a final clear to close. Okay. Any questions on that?
Well, once you're through it all, I would ask, how long does all this take typically?
It can take a while, so it all depends. So it's very important to submit the file as tight as possible. When I say tight, meaning as much of the documentation up front, so that you minimize the conditions from the underwriter. It can take a little bit. For example, underwriting. I mean, when I say submit to underwriting, it goes into a queue. It could be 3 to 5 days before an underwriter actually reviews the file. Right now, files are a little bit backlogged because of so much in refinances are happening. But typically within 48 hours on an initial underwrite, and then between initial underwrite and the second underwrite, the final underwrite, it all depends on how fast we can get the documentation from both the borrower as well as the third-party vendors like employers and banks and rentals and all. It all depends on that. If we have issues with collecting any of that, then that's where I jump in and talk to the borrower, talk to you, the real estate agent, to maybe you can help out, jump in and tell, hey, you know, Mr. Borrower, please get this over to them, whatever it might be. But typically, right now, it's taking the full 30 days to get a full underwrite in. I've seen them done in lately, you know, as low as 24 to 25 days, but that's typically the length of time it can take the full amount of to get everything in there. A year ago, I could get them done in 15 days. Right now, it's a little bit slower.
Wow.
Does that help, Adrian?
Yep. It just
Okay.
puts it in perspective.
It does. It does. It's when I get that contract, that clock starts, and I look at it and I say, oh my God, they want me to close this on the 7th of October, and I got the contract on the 11th of September. You know, it's tough. So those are the kind of things that I have to watch out for and try to be proactive upfront. Upfront is really, I keep saying that over and over because upfront is huge to me. Getting all those documents up front, getting as much information up front, anticipating, not knowing, but anticipating what an underwriter is going to request is really important. Once the loan is submitted back to the underwriter for final approval, and if all conditions have been met, and that's the key, all the conditions must be met. Sometimes there are conditions there that are kind of strange, and we're trying to figure out how to supply validation to the underwriter. So we can talk to the underwriter back and forth and say, hey, I've got this, is that sufficient? Or what else do you know? It's kind of a conversation behind the doors before we submit it for the final to try and make sure that we got everything. But 99.9% of the time, we've got it all. The file is set, the appraisal is done, value is there, and the file is clear to close status. Okay, the client and the property have been fully vetted, and they can proceed to closing. At that point, the file is sent to the closing department. The closer from the lender will collaborate with the settlement agent, the title company, to balance the closing disclosures. So it doesn't happen instantly that disclosures go out. It still has to validate and work with title to make sure the final CD, our closing disclosure, is balanced and good, and then the disclosures are issued. So that can take about 24 hours, depending on how quick the title company can respond and how backlogged the closing department is. So that is also a consideration. The other thing that happens here, and I know it's here somewhere, here it is, key steps. The other thing that happens is that sometime, and it's got to be sometime before the closing, they have to sign an initial CD or closing disclosure, the buyer does. Typically that, and they have to sign it within 3 days before close of escrow. The idea is to give the client an opportunity to review the fees and the loan and make sure everything is still what they thought it was going to be. And it gives them a 3-day period before so that they can review all that. Typically, this CD is ordered relatively quickly. Usually after the appraisal is complete, then the CD is ordered and sent out. Simply because once we get the appraisal, we know what the actual value of the property is. It could be greater, it could be less, it could be equal to the contract. So that's this CD is crucial. Monitoring the timelines on that is really big, because back when that first was issued, that we had to start doing that, loans were taking, we had to do a lot of extensions because they weren't being issued in a timely manner. Now they're pretty quick. It's pretty down set in stone. Again, clear to close, or CTC, that's what that is. When you see a CTC, it means clear to close. Title company and closers balance all the final CDs. So there's the initial CD, closing disclosure, that was sent to the buyer, and that typically is close to or equal to the final CD with the title company. Okay, but it's equal to. A final closing package is issued by the lender to the title company. They print it out, prepare it for signature. Client goes in, signs all their closing package. Once signed, the closing funds are ordered. Typically, so depending on the lender, some lenders require that you have the closing package sent back before they will fund. Other lenders will do what's called table funding. So they'll actually send the closing package and the closing funds with the closing package. So it's funded instantly on that day. Right now, I know that we are table funding some loans. So that's a good thing to happen. The loan funds, the loan records, it's closed, they get the keys. So any questions at this point? I know some of you came in late, but or later, I'm sorry. If there's anything that you'd like me to cover, please let me know. Okay, don't let it be a stampede.
Do you work directly with the underwriters?
Yes, in what sense?
Like you develop relationships with them over?
Not really.
No.
Not relationships. I mean, you can if you work with underwriters enough, you know, you get to know them and you get to talking to them, but we don't have, you know, deep relationships. They don't.
Well, I mean, you have an understanding of what their needs are. You know how to
Oh yeah,
make their job easier.
exactly. And that's why I kept reiterating, making the underwriter's job easier is by making sure that you have a pretty complete package when you submit it for that initial underwrite.
Yeah.
Yeah, that's really the key part, because once an underwriter sees it, they cannot unsee it. You know what I'm saying? So if they see something and you submit something and they see it, they can't and then you say, oh my God, I'm so sorry, you weren't supposed to see that. Well, that's not going to happen. Once they see it, it's done. So a lot of times going back to, in fact, all the time, going back to the initial AUS, where was that? Right here, the AUS system, the underwriting system. That is where, when I run under AUS or the underwriting system, it tells me essentially the minimum required to submit the file to the loan. So that's where we start. That's where I start. Say, okay, I've got pay stubs, I've got this, I've got that. But then if I see something within the actual transaction that's going to cause a question, then I will start asking the borrower before that. For example, the borrower that has the large deposit in their account, I've already requested documentation. They're looking, etc., for a property, but right now they're requesting documentation as to where that money came from, because I know the underwriter is going to ask for that.
Right.
Okay, so I mean, relationship wise, I mean, yeah, sometimes, I mean, we'll get decent relationships with underwriters where, you know, we can work through income calculations. Maybe their income, they're not calculating it like I did, and we kind of work our way through that. But there has to be some sort of, I don't want to say barrier between me and the underwriter, because, you know, they're making that decision, and they're really looking at the bank, but they're also looking at the buyer. They want to make sure that they want to help the buyer buy a house. They want to make sure that the loan is a good loan so that it doesn't go into default later.
Right. Yep.
Okay. Anything else? Anybody? No? Lindsay, Bernice, Zelica, Martha? No?
Just going off of what you were saying about there are certain things underwriters shouldn't see. So maybe for newer agents, I've had some buyers submit a Binzer, asking for a credit in lieu of repairs instead of an addendum. Do you know where I'm going with this?
So not good.
Yeah.
that is so.
I've seen that happen, and yeah, maybe just going
Yeah,
over that for
you
new
never want to do
agents.
that. Yeah,
No,
you never want.
because
Yeah,
that can make things a bit messy, and a lot of agents they're not aware of that.
yeah, you
That-
never, ever, and that's why I try to collect all the paperwork that the buyer wants. So when I talk, I have a relationship with the processor, Adrian, and I'm just responding to you, Lindsay. So the processor may request a document from the client that I want to review before they submit it. Okay, and if I see if there's something that's being requested and I think that there might be an issue, I want to see it before the underwriter sees it. And in
Mhm.
terms of a Binzer, never, ever
Right.
give that to an underwriter, because
Please.
a Binzer basically says everything that's wrong with the house.
Exactly. It can be a deal killer. So
And it can be a deal killer. And the underwriter says, okay, that's cool, fix everything.
yeah.
You know, I had one years ago that an agent literally was trying to help their buyer, and she prepared a package for the appraiser that included the Binzer because she wanted him to call out certain repairs.
Oh.
Obviously, he called out
Right.
everything.
Yeah. Thanks for the heads up.
Oh my God, it was horrible. It was really, really bad. It was really bad. So yeah, you never want to do that. There's certain things that you just don't, I mean, obviously nobody wants to commit fraud. We don't do that. But if it's something that's how do I put that? I mean, you don't want to hold back information that would identify the file as extremely questionable, okay? But you
Right.
do, there's certain things that you just kind of just pull back and say they don't need to see the Binzer. They don't need to see, you know what I mean? There's certain
Yeah,
things that
just
they just do not need to see.
using an addendum
Yeah.
for credits instead of the Binzer.
Yeah, an addendum for credits or that kind of thing. And also in terms of contract, let me see where I was going with that. So a buyer cannot get cash back on a purchase. Everybody knows that, right?
Mm-hmm.
So oftentimes somebody will say, hey, can I finance this? And let me throw in an extra 5,000 so I get some money out of it. No, you can't do that. You can't make a profit on a purchase per se. You can't make money on a purchase. So when you do an addendum for credit, it should be a credit towards something like closing costs or something like that, because they're not going to get the cash, okay?
Mm-hmm.
Unless we do an escrow holdback to repair something and the seller's paying for that, but that's a whole different ball of wax, okay? So you want to do that. That's pretty much, yeah, that's it. Thank you, Lindsay.
Yeah.
Yes,
Anything else, anybody?
yeah, that's good stuff to know. So I don't stumble into that one.
Yeah.
Hey, anytime, yeah. I mean, if there's a question about it, it's always good to pick up a phone and call me or call somebody to see, just bounce it off them and see what they think,
Yeah.
I've been around a lot and I've seen a lot of crazy things. So I might not have all the answers, but I'm pretty sure I know someone that did or it happened to.
Yep.
Okay. All right, you guys. So that's pretty much it. If you have any questions, anything at all, I appreciate you guys attending this and letting me be a part of it. And again, if you need anything, just reach out anytime. All right.
Okay. Thanks for your time.
Bye. Have a great day.
Thank you.